Okay, I think we're going to get started now. Good morning, everyone. My name is Mitch Nussbaum. For those of you that don't know me, I am the co-chair of Loeb & Loeb. We're a 500 attorney law firm. I specialize in doing a lot of capital markets work, IPOs, SPACs, follow-ons, and so forth. I've been in and out of the deal flow conference here for 22 years, so I've probably run across many of you. But this morning I have the great privilege and pleasure to introduce to you Alan Patricof. Alan has been in the finance business for 70 years. And out of those 70 years, he's been in the venture capital business for 55 years. So he was at the venture business when the venture business started. He had the opportunity to invest in companies early on that we've heard of, from companies like Apple, AOL, Office Depot, Cellular Communications, New York Magazine, Sunglass Hut, Audible. The list goes on and on, but you know, that's just a bunch of names. Alan has published a book called No Red Lights. It's in we have a bunch of copies in the back. After we complete our fireside chat, Alan will sign some copies. I personally read the book, and I recommend that.
I hope you read the book. If you're going to ask me questions.
Yeah. And I recommend that you do read it. It's fascinating, particularly being in the small cap business that we're in. Thinking about, you know, where things were 30, 40 years ago, and we'll talk about that. Alan is proud to say that he's going to live to 114 years old. He's 91 right now, and he's as sharp as a tack. So read the book, and maybe you'll learn how to learn to live to 114 also. So let's start with the beginning of the venture capital business. Alan had, you know, worked on Wall Street, had his finance jobs, and on the side, at a very young age, really started figuring out how to pull a bit of money together to seed some companies, and then had the courage to break off on his own and form, in 1969, Alan Patricof Associates. That was the APA. The X came later in Apax. So, Alan, why don't you tell us a little bit what venture capital was like back in 1969? It was like the very beginning of the industry. How was it like to really create something from scratch?
Thank you. Yeah, I'm blind. When I started in 1969, there was no venture capital industry. It wasn't called anything. We used to call it development capital. I recognized that were investing portfolio in their family office, and I had worked for a family office at that time, not my family. I couldn't have afforded a family office then or now, and I saw that everyone was going to public security, but every one of these were dabbling in the private market in one way or another. In those days, the famous names were Gus Levy and Goldman Sachs, and Lazard Frere, and J.K. Wertheim and Company. Those were the major names that were doing deals. It wasn't Morgan and Goldman Sachs. And they would call up these family offices and say, I'm doing an oil deal, I'm doing a glass deal, I'm doing a steel deal, I'm doing a technology deal. We put in $500,000, $250,000, $1 million. And all of these groups dabbled in what we would now call venture capital, including the family office I worked for. And nobody had any interest, but they wanted to be part of this club. So we would take a piece of this deal or that deal and then literally put it in a file drawer after the closing, because it was paper closing. And no one ever looked at it. And I, as the young guy in the office, the firm was a company called Central National Corporation, which was the Gottesman family, which was in the pulp and paper business for their main activity. And They're really very philanthropic. They're known primarily for having built the Shrine of the Book with the Dead Sea Scrolls in Israel, which was a major thing many 10, 20, 30 years ago. And I used to look in these drawers, and I got really intrigued. And as a result of that, when we made a small investment in New York Magazine, I got involved in it and became operationally involved during my spare time and became chairman of the board at one point. And then I had a company called Datascope Corporation, a medical electronics company, and I loved that. And a company called Lynn Broadcasting, which we ultimately sold to AT&T. And I said, this is more fun than analyzing IBM and General Motors and a paper company. And so in 1970, I decided I'm going to go to all these family offices that I knew and be their outsource investment arm for any of these private deals that nobody cared about. And if they brought the deal to me, they would give me, at that time, a 10% carry. And I formed what you might call a club of 10 clients who paid me $250,000. Excuse me, paid me $25,000 a year, which was enough to start a business. And then if I found something, I'd bring it to them, for which I got a carry as well. And that was the basis of Alan Patricof Associates. And in those days, I hired one or two people. You could do that with $250,000 of fee income. I on top of that, raised a fund of $2.5 million, which gave me a little more income. And I'm happy to say that for every single year since 1970, I've been successful enough to make a profit. I don't believe in losing money. And we gradually built a portfolio, but the phone didn't ring that much then because there weren't many people around like you, and there weren't many people who were entrepreneurs starting up businesses, and there were not that many. There were certainly no venture capitalists around. So our first investment was in the secondary lead smelting business. I want to give you that sense that it wasn't Apple Computer and it wasn't an AI company. It was the lead smelting business. And interesting in the fact that reflecting on it, the company was a company called RSR Corporation. We started with a $250,000 investment, and that company still exists today. It is probably has annual revenues of $3 billion, and it's the largest secondary smelter in the world. So I got into the business that way. The phone hardly rang. We probably, if we were lucky, probably looked at 100 deals a year. Today, in the firm that I'm running now, Primetime Partners, we probably look at over 1,000, well over 1,000 a year, and the phone never stops ringing, and the emails don't stop coming in. It's not the phone ringing; it's the emails that come in, and you almost can't stop the flow. So there wasn't a business then. There weren't a lot of other venture capitalists. There were several other firms that started around that time, and there was in California was where it really was happening. New firms started like Sequoia, which still is in existence, and other firms of that nature. But the industry kind of bifurcated West Coast and East Coast. A few years later, I started up an operation in Silicon Valley as part of Alan Patricof Associates. So that's where the business was. And it was really, at that time, there was virtually no public market for these young companies. The deals were small. The exits were mostly an M&A transaction. And it wasn't until the late 60s and early 70s that we started seeing some form of, the late 70s and early 80s that we started seeing an IPO market and what you now call microcaps. Just to put in perspective, I made my investment in Apple Computer as part of APA, Alan Patricof Associates, and we invested $315,000 in it. And if you read my book, at the time I wrote the book last year, it was I had a computer program developed just to keep track of it, even though we have no investment in it now, and the stock that we bought at that time was distributed to the limited partners I had, would be worth, if we'd held it, would be worth $7.5 billion. So compounding works. And that was, the IPO market really kind of took off in the late 70s and early 80s.
So, Alan, it starts as a small, intimate cottage industry in terms of the VC world. Is it this small cap public market that takes it to like a global asset class, or what takes the venture capital industry from where it was in the 70s to what it became? And did many of those companies find exits ultimately in the 80s through small cap or other IPOs?
Well, today the small cap IPO, I mean, most of you are in some form of that activity, but the venture industry is almost entirely investing in private deals, not in public deals. And today we're in an environment where in the world I'm in, I mean, you can't get an underwriter to take on a company that has a market cap of less than several $100 million. Now there's lots of micro cap activity, but it's a different world. But when I started out, that's all there was. And you have to understand, for early venture deals, Shelby, in the early IPO deals, I mean, my first IPO was in 1972 when I took Datascope public, and we raised $2 million on a $10 million valuation through a firm called Underberg Tobin, which Mitch knows, which doesn't exist anymore. But that was not that unusual a size deal. And in those days, it was all individuals. There were no institutions. The industry changed in 1976. And what really built the venture industry was a regulation that changed in 1976 called the planned asset rule, which was a rule that until that time, pension funds were not allowed to invest in a fund. They could analyze the fund, but they had to analyze every single investment in that fund. So in order to qualify, it was an impossibility for them to go into a fund that was going to have 20 or 30 investments. So as a result, they were not allowed to. In 1976, that rule was passed, which enabled them to go into venture funds or private equity firms or growth funds and not have to look at the underlying holdings. And that opened up we really became an industry in '76 when pension funds, endowments, and any institutional organization that had any regulations was able to invest in venture funds, and that exploded the industry. And as a result, today there are thousands of venture firms around, and have raised, multiple $billion. But today, unfortunately, what we started with were individuals investing in small cap companies with no institutions. Today, the institutions have pretty much crowded out the small investor, because from an IPO standpoint, an institution won't buy buy less than a 10, 15, 25 million dollar position in a company. And so they've crowded out the individual who in those days would buy 100 or 500 shares of whatever price the stock was. So it's a different industry today. I personally love that business. In my book, if you read about it, you'll read about a lot of what the market was like, what the business was like in those days, and you may see a lot of the firms you heard about or recognize and names that you recognize. I mean, for example, Sandy Weil, who became chairman, CEO of Citicorp, started out with a little tiny investment firm called Carter, Berlin, Patoma, and Weil. And they did a lot of underwritings, and from that, Sandy built that into what became Citicorp. But there were a lot of people on Wall Street, or people like myself, who were there in those days, who have built firms over the years. I built Alan Patricof Associates from that $2.5 million fund to what is today a private equity firm. Became APA with an X because we went international. We have offices in 12 countries and run $87 billion. And as you can imagine, it's not a venture firm anymore. It's a private equity firm, which is why I decided in 2006 to start another firm, which I was determined will be a pure venture firm. It was started with $75 million in capital. Today, that firm called Greycroft is now a $3 billion fund, and they've morphed into growth capital as well. And so 5 years ago, I decided I got to get back in venture a bit again, and I started a company, which my tag called Primetime Partners, which is a $50 million fund, which focuses solely on early stage investments in the serving the longevity market, longevity, aging, and wellness, which is to me, a very interesting area, and lots of opportunities because there'll be more people over 60 than under 18 by 2030, and they have more money to spend, and it's a very fast-growing market.
So, Alan, in your book, you talk about when you look at a company, what are the fundamental factors that you look at in terms of investing in a company. You mentioned you look at number one, a large market to serve. Two, a product that addresses a clear problem or need. Three, sound economics, and four, management team in which you have confidence. You also go on to say that it's about the jockey and not the horse. So maybe you could speak to a little bit about how you evaluate a company for investment.
Well, contrary to most people who write or speak, they give you different answers. I give you the exact same answer. So I'm glad I'm consistent with what I wrote. In the end of the day, you've got to be backing an individual. You can have the best product, but if someone doesn't know what to do with it and doesn't have the vision and the determination and commitment to build it, it's going to die on the vine. And that's why you hear a lot of companies pivoting, is because the product wasn't necessarily good, but the guy who's running it recognized it was not working as intended and has the vision to change it. So what I look for still is a entrepreneur that I believe in. Mitch and I were discussing last night, or maybe this morning, in the business of venture capital, and probably what a lot of you are doing, investing in now, with young companies who don't yet have a big market or a big revenue line. You want to believe that they have a vision of an opportunity to build something into something more than a cottage industry. You want to, and in today's world, I don't think you'd find a venture firm that would invest in anything that had less than $1 billion market, because you're never going to get all the market. You're going to get a share of the market. So if you're going to get, and 5% is pretty good of any market. You got a $5 million $5 billion market. If it's only $100 million market, if it's $1 billion, you got a $50 million company. Still not very big. So venture capitalists, rightly or wrongly, are focused on big market opportunities, and people who think they're going to something that has a proprietary difference. And not necessarily patents. I'm not a big believer in patents. There are exceptions. Coca-Cola has a patent. Lots of people have, but that's very unusual. Most times when people come to venture capitalists and show off in their first slide all the patents they've got. That's not the symbol of success. Better still is to understanding what the competitive landscape is, what the potential market is, what the proprietary difference. Do you have a better cost differential in terms of ability to get source raw materials? Do you have a better ability to not necessarily price your product higher, but because of your cost structure, you can price it less than what other people are selling it for, and that you have some guardrails around that help to give you some proprietary advantage that give you an ability to have a margin that can afford to pay for the marketing costs, in addition to the cost of materials, but a marketing cost, and to make a profit, and that you understand how much capital it takes to build that market. I mean, I get depressed when I see how many people come to see us who have no sense of what the economics of the business are and what kind of capital it's going to take to produce it, and is the prize at the end of the day worth the effort and expense to get there. You read about all these companies who have millions of dollars put into them, have really, their outcome is limited because they don't, in the outset, think about what the end game is. You didn't ask me, Rich, but I will just throw in, I'm not an expert in AI, but I have been around for a lot of revolutions. The PC revolution, the biotech revolution, the cellular revolution. I invested in the first cellular company, just as a throwaway. The first cellular company started in 1981. The government gave away in a lottery spectrum. So I participated in that. I participated in the storage revolution, the satellite, everything that's been around since 1970. I've never seen anything like AI. It transcends everything because it touches everything. No one knows where it's going to go. And the only thing that concerns me is, having been through all these revolutions, I've seen the winners and losers. And last year, $225 billion were raised for AI companies. All you got to do is put AI in the name, tell somebody you're working in AI, and it seems like you can sell stock at infinite prices without any sense. Nobody really has a full understanding of what it's going to be. Big. It's going to. I don't argue with it, but all of these thousands of companies that are starting and raising infinite amount of capital, and the reason they're raising the capital is not because someone has done any of the exercises really of figuring out what the end game is, but everybody wants to be in the business, and that's why you're finding people are, a lot of these AI companies are buying other AI companies, chip people are buying software companies, everyone's buying each other, and there's an enormous amount of capital, and there's going to be a bunch of winners, but I promise you, having been there before, there are going to be a lot of losers, and I hope a lot of them are prepared for the kind of losses they're going to see.
So you're seeing another bubble like we saw at the .com. In other words, there'll be some winners, although it's hard to determine, right? I mean, you have valuations on some of these things that are through the roof, these chip companies, storage companies, we know the names. But what you're seeing is a similar sort of play out where you're going to have some winners, but the rest of them are just significantly overvalued and in a bubble?
That bubble word scares everybody, but when I'm not up to the minute. You have to be up to the minute, but I think OpenAI was raising money at $350 billion valuation. Well, and people are investing, lots of people, and if they invested at $350 billion to make 10 times your money, you got to be worth $3.5 trillion. I mean, we're playing in numbers today that nobody can possibly extrapolate and quantify. And as I say, it is such an exciting area. And I am, by the way, afraid of the consequences from a negative standpoint of of what could come from it, and it's not going to be all good. And people can use it for evil things easily, so that does worry me. And having some kind of legal framework, I think, is absolutely critical. And I think, frankly, some of the leaders, like the head of Anthropic, recognizes that there's got to be boundaries put in someplace, and there has to be some kind of regulations, or else this thing will run away from us and be out of control, on a worldwide basis. But bubble, maybe bubble. I just think that we are definitely looking, and I don't know which ones, at some excessive valuations.
So in your book, you talk about how, and this is sort of related to the AI point, we're just talking about how fundamentals have gone out of fashion, yet you were in the venture capital world for so long. How do you find those two statements to be, those two concepts to be compatible?
Well, I've been on the board of the Columbia Business School, of which I'm a graduate, for many years, and they teach value investing. And so I get asked that all the time. How can you be trained in value investing at, like, Warren Buffett? He was the class ahead of me at Columbia, and be in the venture business. And the truth is, if you're a value investor, it's tough to be in the venture business. However, it does give you sufficient training in terms of economics, in terms of valuations, in terms of what it takes to build a business, that it does, and I'm not rationalizing, it does help me in many instances, being with people who haven't had value investing training and who are just tech investors, technologists, or just have made an expertise of this type of investing, that gives me the ability to participate in the conversation and understand reality. Because at the end of the day, I mean, you have to think about what the ultimate end game is, and you can't lose sight of that. On the other hand, I have to admit, I probably have lost out on some investments because I was too disciplined in my approach.
Yeah.
But I had undisciplined people around me.
So again, in your book, No Red Lights, you talk about a lot of lessons. If there's one lesson or two, and I want to limit you to one, that you want your readers to walk away from when they read the book or otherwise, especially founders, builders, to take from your life, your experience, what would that be?
That's a hard one to narrow everything down to one. I would say I'm not going to give you the answer to it, but I'll try to think of that. But I have built my life based on a reputation. I mean, if you're in this business for as long as I have, I've never sued anybody. I've never been sued. I run a very, very ethical, tight business. I don't commit to doing deals and say, pencil me in, and then back out. My word is my bond. I think building a reputation for yourself is, to me, very important. Now, that's not the answer to your question, but I would say, from a standpoint of investing, is invest in people who are dedicated, who really have a passion for what they do. I teach a lot and give a lot of lectures, and when I was not in the last year, but 2 or 3 years ago, at a Columbia class, on more than one occasion, I'd say, how many of you in this class are going to start your own business? And 90% of them would be starting their own business. And I'd say, why? Have you had any experience? Have you developed a passion? Are you going to start a business just because you're going to start another delivery company because you saw someone else last year starting a delivery company and they made a lot of money quickly? Develop the tools of expertise to build a business, understand how to build a business, how to attract people, how to build a culture, and have a passion. I love people who have a passion. I mean, Mark Zuckerberg had a passion for what he wanted to do. I'm just throwing him out as an example. Jeff Bezos had a passion. I liked it. I love to invest in people who really know the area they're going into, perhaps have been in it before, and learn the pitfalls, and they're dedicated, and they'll kill themselves to make it a success. And you want to be around those kind of people. It's fun to be, and it's profitable to be associated with people like that. Because remember, when you're an investor in a private company, I was taught this by the man, and I'll finish, who I worked for at Central National. When I told him I was leaving, he said, "I don't know why you're leaving. You can go home at night and take your inventory in a black binder and go and look at it while you're at home, or not look at it. You can come in the next morning and decide, I don't want to be in anything in here, and you can sell it all tomorrow. You're going into a business where once you write that check, you're a partner in the business, and you can't change your mind tomorrow." And believe me, that's guided me throughout my career. When we make investments, we're partners in that business, like it or not, and we have to live with that entrepreneur. And we don't have liquidity, and therefore you better like being with that person. You better believe in it, and you better be willing to go through the ups and downs.
Thanks, Alan. I think there's one last question, then we'll take questions from the audience.
Come out and read my book. I'm going to sign books here for the next hour.
Last question.
It's free.
And I'm asking this just because a lot of people here in the small cap space, we talked last night about what the micro cap or small cap space used to be like. How, for really what it really became was public venture capital back then, with some of the underwriters that we talked about, that are named in the book. A lot of individuals at that time were investing in micro and small caps. It's changed, right? It's mostly hedge funds these days, as you said, institutions, but a certain type of institution. And how do you see how that plays into the way small cap or micro cap was like 20, 30 years ago, at least when I was starting?
I'm sorry, rephrase it a little bit. What's the specific question?
In 20, 30 years ago, right? When you looked at small cap IPOs, they were like real IPOs, right? These were deals where, you had companies that went public. I mean,
well, the IPO market was the venture capital market in those days. I mean, you didn't have a lot of venture capital firms around to go shop your deal. So if you could find, and there were a lot of small cap underwriters, because of the economics in that business and the big sheet availability and traders working with traders, that was a viable market. You could go to see dozens of underwriters, most of whom were absorbed or aren't here anymore, and you could find an underwriter who would do a small cap underwriting, and they would provide liquidity in terms of market making, and because the economics and market making were there. And today those firms are all gone, and market making is different. And as I say, if you have a small cap, there aren't that many people who are going to do the kind of underwritings that were done then that were really venture capital.
Great. Any questions from the audience?
You have to scream because it's a big room. I'm sorry, but politics gets involved. So I'm not a big fan. So I position myself right there. I don't put Tesla in the category of, I mean, Elon Musk had a passion. I mean, let's not kid ourselves. And, there's an investment firm called Barron Capital, Ron Barron. Ron Barron believed in Musk from day one. He has never sold a share. I'm out of date, but he never sold a share. He bought more. When it went down, he'd buy more. And he believed in him. I've had only one interaction with Musk, which was down in St. Bart's at lunch 10 years ago. A lot of people have made a lot of money, including some of my sons who've invested in SpaceX and other companies he's been involved in. I can't judge the individual. I think you got to figure but for political reasons, I just can't bring myself to getting involved. And he's in the public market anyhow, it's not in the private market. Yeah, I think I could say if he started a new private company and was raising money, would I invest? No. Well, you were asking an absolutely perfect question, and one of the big challenges. The first one's easy. If you have enough capital and you go into the seed round and they're raising an A round, you certainly should be continue to support it. The conditions I've talked about are still there. You still believe in the company. You believe in the management. You think the market hasn't gone away. Has the market gone away? Let me say it differently, because I think that I put that in the book also. If the market you thought was there is not there, if the product is late, if you don't like the person individually, if the economics of the business that you invested in still don't hold, then I would definitely not follow on. But if you have, the question is, if you have one of those four, or you have two of the four, and not three of the four, or four of the four is easy. But if you have one or two of the four, how do you do it? If you have none of the four, that's a simple decision. Take your write-off. And frankly, conversely, I have had many discussions with entrepreneurs who have killed themselves to build a company and have raised money and more money and more money, and it hasn't worked yet. And I say to them, and I would say that to this day, maybe this is not what you should do. Maybe you should take your talent and put it in another direction, because clearly it's not going to help to keep raising money and you're not going to get there. You're working, you're getting $50,000 or $100,000 a year salary from yourself. You have a bigger potential running something someplace else. The answer to the other question was not about supporting it. Well, I've answered supporting it and knowing when to cut. I've answered both your questions.
Hi, Alex Torches here from Toronto.
Over there.
What do you make of the current natural resource super cycle, and do you think there's a place for it in the more traditional venture capital where there hasn't been more exploration and earlier stage?
Unfortunately, I would say the venture business is not set up to go into natural resources, as you discussed. I personally invested about 20 years ago in a company called, I don't want to promote a company called Ivanhoe Mines, which was developing mines in the Belgian Congo and that part of Africa. And it's been 20 years, and they only opened up their mine a year ago. And that was just something I went to actually through Montgomery Securities. And it was a personal investment. Venture capital firms are not be in investments that take 5, 10, 20 years, except for perhaps biotechnology. And maybe there's those who specialize in oil exploration. But basically, capital investments, we all run funds. Funds are 10 years in life. It's almost standard. Although, based on my experience, the average length of time to liquidate a fund is usually between 14 and 17 years, even though it says 10 years on the cover. And it's very hard to get a venture firm to be interested because they have to sell the next fund. And in order to sell the next fund, you have to show results from the fund you're running. So if you don't have, and you really, the cycle is probably every 2 or 3 years. So it's very difficult to be in capital intensive, long-term projects like mining or discovery. It's a very interesting area, but I just, it's designed for very specialized types of
All right, let's thank you. Oh, we have more questions. Sorry.
Alan, what are you most excited about with the longevity sector that you're investing in? Is it the AI piece component of it? Is it breakthroughs?
No.
Okay,
When I started 5 years ago, the AI wasn't even in the lexicon. And maybe it was, but it was very, very insignificant. No, I just among besides running the marathon 2 years ago and going to Burning Man, I also got married 2 years ago, and but my previous wife died of Alzheimer's about 5 years ago, and during her long illness of almost 12 years, I got to go to a lot of conferences and got to meet a lot of people and read a lot of material about what was happening in the aging community. And I got to recognize that it's the fastest growing part of the population. It's a huge market. Older people need everything and more. And there was a big opportunity that was really, from a venture capital standpoint, people weren't addressing because it wasn't sexy, and it's still not sexy. You make more money in a high-tech company than probably investing in the area I'm in, but it's a growing, very fast-growing market. As I say, there'll be more people over 60 by 2030. They'll be under 18. Older people tend to have more money to spend, and we don't invest in pharmaceutical or biotech. We invest in products, services, and technologies that serve the I like to call the ageless generations, plural. And I kind of came to recognize that, and I happened to get involved with a woman who had been not personally involved, but she had been the founding. I invested in Arianna Huffington's company, Huffington Post, and this woman had been the founding president with Arianna, and I was on the board. I had invested in the Huffington Post, and she shared the same kind of vision. It wasn't at the Huffington Post anymore, and we were brought together and realized that we both had this recognition of a very fast-growing market. I mean, when we started 5 years ago, you didn't hear the word longevity. Today, there's not a day that goes by. There's not a conference or an article, or it was the feature story. There was the feature of the cover of Time magazine in early January. It's a very sexy subject now, and it has lots of opportunities. As you all know, someone who, getting caregiving or will need caregiving, and it starts with that. The amount of facilities that are being built and who have need for services is increasing every day. So I think it's a very interesting area.
Question over there.
First of all, congratulations. and I want to,
What are you congratulating me on?
for everything that
living?
you represent, and sincerely, it's with all humility, congratulations. I want to talk about the X part of Apax. You spent a lot of time talking about the job people you invest in, their passion, their commitment. And now that you're looking at internationally, when Apax came in international, I want to bring in the culture part. Executives from different parts of the world have a different trigger. How would you measure that when you're making investment in individuals and people?
Are you asking me about investing in companies in other parts of the world?
That's right. And since you talked about largely focusing on leadership and individual and people, and they can be very divergent, how do you address that?
Well, I mean, being very honest with you, we invest primarily in the U.S. We have invested in one company in the U.K. When I built Apax, it's over a long period of time. I had partners in each of these countries that I developed, particularly in England and France, and we then spread out from there. I built a culture in New York and California, and I'm very big on building cultures. I think it's very important. I am a big believer in 5-day work weeks in the office. I hate virtual companies. Unfortunately, there are too many of them. But I think if you want to have long-term business growth, you want to build a culture around quality and about integrity. And I think you want to be able to spot that, but I think it's a challenge. If we go into it, if we were to do a deal in another country, we would have a partner locally who we trusted, and we would co-invest. We would not go into another country and invest on our own.
All right, that's all the time we have. Alan will be signing copies of his book right here in this room in just a couple of minutes.
Thank you, everyone.
It's in the back.